Welcome everyone to Let's Get Together, Mergers, Acquisitions, and Benefits Compliance. Thank you all so much for joining us. Roger will be answering the questions you send through the Q&A today. We will try our best to answer all of your questions, but if for whatever reason we are unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At this time, I'd like to introduce our speakers for today's call. Joining us today are Carol Wood, Vice President and Counsel of Benefits Compliance at NFP, and Patrick Myers, Vice President and Counsel of Benefits Compliance at NFP. Patrick, the floor is yours.
Thank you, Amber. Welcome, everybody, to our webinar about mergers and acquisitions, specifically the benefits compliance issues that may arise in mergers and acquisitions. These are your hosts in case you need faces to names. Carol and I have several years of experience working for NFP and dealing with these issues. So hopefully in the next hour, we'll be able to guide you through, at least at a high level, those benefit considerations in this context. But of course, our obligatory disclaimer that this is not intended to be tax or legal advice. If you have a specific question about a specific legal issue, that should be addressed to your legal counsel. And the information that we're presenting today is current as of today, January 24th, 2024. Our agenda today, we're going to be covering first some background and some preliminary points. Specifically, we want to introduce you to what we consider to be one of the more important questions to ask when you're dealing with benefits compliance, which is whether or not the merger or acquisition is an asset transaction or a stock transaction. Then we'll cover some ERISA considerations. We'll discuss how the ACA employer mandate may affect a merger or an acquisition. Then we'll move on to COBRA obligations. We'll look at cafeteria plans and specifically health FSAs. We will then wrap up with some non-discrimination rule discussion and some key takeaways. A couple of other points to acknowledge before we move on. This presentation is going to focus on the health and welfare side, although there is, of course, an important retirement side as well to an M&A transaction, but we're just going to focus on the health and welfare side. If you do have questions about retirement, you should consult with your counsel, plan financial advisors, record keepers, and other retirement plan vendors if you have questions about that specifically. This is a very complex topic, and we're only going to be giving you a high-level overview of these considerations. But these slides will be available after the presentation, and we also have an excellent publication on benefits considerations in the mergers and acquisitions context. So please talk to your NFP consultant about those, and should be able to get those to you. So first, let's start with some background and some preliminary points. This past year, M&A activity has really slowed down. It's due primarily, we think, to the high interest rates and increased costs, which has dampened enthusiasm for these kinds of transactions. But that said, the stock market is going strong, and it might make M&As more attractive this year. But in any event, employee benefits normally don't really drive the transaction, of course. And unfortunately, benefits are often overlooked until after everything is done, which can result in compliance and employee relation issues, as well as potential liability. So there are a couple of things to do when you're dealing with this issue. And the first thing that we recommend is that you inquire about the other party's benefit plans as early as possible. When you're contemplating a merger or an acquisition, it's a good idea to know what you're dealing with in the benefits compliance context. It's important to highlight benefit compliance issues requiring review during the due diligence process. Identify what those issues may be so that you can start addressing them. It's also important to understand the structure of the transaction itself. Again, you want to determine whether or not it is a stock or an asset purchase. And it's also important to verify whether or not there will be a control group as a result of the merger or acquisition. It's important, of course, to know the default rules that are applicable to mergers and acquisitions. For example, COBRA has some default rules, which we'll touch on later on in the presentation. It's also really important to engage employee benefits counsel to help you early and often whenever issues arise during the course of that transaction. And then finally, it's important to determine each party's benefit plan obligations and then incorporate those into the contract. So let's talk about the two types of transactions that we'll be discussing today, the asset transaction and the stock transaction. When we're talking about a stock transaction or a stock purchase, we're talking about a situation where the buyer purchases the stock or ownership in the seller's business or a unit of that business. So, for example, the seller owns Company A and Company B, and the buyer purchases all of the stock of Company A from the seller. So now Company A is now owned by the buyer and is a member of the buyer's control group. Now, with a stock purchase, employees of the purchased business would continue to be employed by the same legal entity, but the ownership of the entity is transferred from the seller to the buyer. Now, a merger, when entities merge into a single business, it usually occurs in connection with a stock purchase. When we talk about an asset purchase, what we mean is that the buyer is purchasing some or all of the assets of the seller's trade or business, and may also be assuming certain liabilities as a result of that transaction. So, for example, the buyer purchases a manufacturing plant and equipment from the seller, so that as a result, the buyer owns the purchased assets, but has no ownership interest in the seller's company. The employees of the purchased entity would normally be considered terminated employees of the seller and may be entitled to COBRA as a result. And we'll get into that, of course, a little later. But if these employees are rehired by the buyer, they would be considered new employees of the buyer. And the implications of those, of course, we'll explain in a little more depth later on. So let's dig in a little bit into ERISA considerations. And to that, I'm going to hand this over to Carol.
Thanks so much, Patrick, for that great introduction. And yes, we'll be discussing ERISA considerations, and I'll warn you, we are going to be discussing control groups a bit. So ideally, that being the key word, ERISA compliance begins during due diligence, so the buyer can evaluate any potential risks associated with the seller's plans. Liabilities can arise from past failures, for example, later unfiled Form 5500s. We know there's no statute of limitations there, and we also know the ERISA penalty amounts were just increased recently. These potential liabilities are of particular concern with a stock purchase, where the buyer is purchasing ownership in the entity and would generally be assuming the liabilities of the entity. That would be the case just by operation of law. By contrast, with an asset purchase, the buyer is selecting assets to purchase, so past liabilities generally remain with the seller, although the buyer could agree to assume certain liabilities under the contract. So yeah, it's always important to know the structure of the transaction, but realize that the parties can negotiate around their obligations. So you need to know the details of the transaction agreement as well. In any case, copies of plan documents, SPDs, and Form 5500 filings should be reviewed, and the buyer should understand the funding of the seller's plans and ensure that plan assets are properly handled. Now, in most cases in the health and welfare context, the plans are considered unfunded and there isn't a trust, but if the seller did maintain a trust, then fidelity bond and other requirements would attach. And the buyer may want to review the terms of any existing fiduciary liability coverage also to determine whether changes will be necessary because of the transaction. For ERISA and other purposes with any acquisition, it's important to understand the controlled group status of the entities under the Code Section 414 rules. And there are two basic types of control groups. So we're just going to review this very high level. First is the parent subsidiary, where one or more corporations are connected through stock ownership with a common parent. The parent must own 80% of the stock of at least one other corporation, and 80% of the stock of each other corporation must be owned by one or more corporations in the group. It's easier to illustrate by example. Let's say we have the parent corporation that owns 100% of subsidiary A, which owns 80% of subsidiary B and 90% of subsidiary C. So The parent and subsidiaries A, B, and C are a parent subsidiary control group under the 414 rules, and therefore they're considered one employer. And I just want to note here that although the rules refer to corporations and stock ownership, the general concepts aren't limited to those entities. You know, they would apply to partnership and other entity forms as well. And the second type is a brother-sister control group, where a group of corporations where there's one in which 5 or fewer common owners, who are individuals, estates, or trusts, directly or indirectly have first a controlling interest that's generally 80% or more in the stock of each corporation, and then effective control, which generally requires 50% ownership of the stock of each corporation, but only to the extent stock ownership is identical with respect to such corporation. And I realize that's quite a mouthful. So let's look at this by example. To the first prong, we need to determine if there's a controlling interest. So we have these 4 shareholders, and they have ownership in 2 corporations, D Corp and E Corp. And we can see that looking at the 4 shareholders, they meet the first threshold, the controlling interest, because they have 80% or more ownership in each corporation. But then we need to look at effective control, and that generally requires 50% ownership of the stock of each, but only to the extent it's identical. So if we look here, we do meet the 50% threshold when looking at the identical ownership with respect to each corporation. So as a result here, D Corp and E Corp are members of the same brother-sister control group, and they're considered one employer under the Code Section 414 rules. Now, these are simple, at a high level. These control group determination can get very complicated. So it's important that if you're uncertain as to the control group status, particularly M&A context, that you consult with a tax professional or legal counsel. Next slide. So why does control group status matter? Why am I subjecting you to this drudgery of the tax laws? Well, generally, members of a control group are considered one employer under ERISA, and employees of different control group members can participate in one group health or welfare plan following the transaction. If the arrangement is not a control group, then allowing employees of more than one employer to participate in a plan creates a multiple employer welfare arrangement, a MIWA. And MIWAs are subject to additional federal and state laws. The DOL regulates on the federal side with respect to reporting, disclosure, and fiduciary conduct. But the state laws come into play. These are promulgated by the state insurance departments, and they may require licensure, registration, funding. Some states don't even permit self-funded MIWAs anymore, I believe California. So it's really on the state side that these laws can be quite onerous to navigate. So how does this come up in the M&A context? Well, one example would be if there's an asset sale and the seller allows the former employees who are now working for the buyer, they're employees of the buyer, to remain on the seller's group health plan after the transaction date. And we receive this question quite often in the M&A context, where you have that asset transaction, and the employees of the seller are no longer employees of the seller, they're former employees, and they're now employees of the buyer. And the question is, well, just through the end of the year, can we leave those employees on the seller's plan just so they don't have to make any adjustments? It'll be a smoother transition if we can wait till the next plan year. But unfortunately, there really is no exception under the laws for that. So that's an issue that you'd really have to discuss with your legal counsel, and perhaps something can be worked out with the state insurance departments. But in any case, just know that it's problematic to leave employees on the seller's plan, and that MIWA concerns can arise. So what options are available for the plans? And absent any specific transactions, any specific provisions in the transaction agreement, the buyer generally has discretion to determine how to address the benefits for newly acquired employees. So the buyer will need to decide whether to continue to maintain the seller's plans for the acquired employees. The buyer could retain those plans indefinitely or just for a temporary period, maybe through the end of the plan year. Create new plans for the acquired employees, or cover the acquired employees under their own existing plans. And the latter is probably more common. The buyer may even want to transition those employees to their plans as of the closing date. Now let's look a little more closely at the plan options and some of the pros and cons. If the buyer chooses to maintain the seller's plans, this could ease the transition for acquired employees. They can continue with coverage tailored to their population. Considerations here, though, would work against the goals of uniformity in the corporate culture and the benefits. It also creates additional costs and plan administrative and legal requirements due to multiple Form 5500 filings, plan documents, SPDs, and communications. The buyer would need to ensure that any contracts with carriers and service providers are updated to reflect that new sponsorship. Now, alternatively, if the buyer decides to cover the acquired employees under the buyer's plans, this could help to integrate the employees into the buyer's organization. Inclusion in one plan also avoids those additional costs and administrative burdens of maintaining several plans. Of course, the plan document would need to be updated, and plan disclosures, your SBCs, SPDs provided to the acquired employees. Other considerations are if the acquisition occurs mid-year, the affected employees may experience disruptions in coverage and additional costs. And one issue that comes up is deductible and out-of-pocket credits. They may be possible under the buyer's plan, but that would be something the buyer would have to review in advance with their insurer or stop-loss carrier. And the seller should also review their contracts and notify the carrier and TPA as necessary. And if the seller's plan will be terminated, then keep in mind a final Form 5500 would need to be filed. And with that, I will turn the presentation back to you to discuss the ACA obligations and the employer mandate, Patrick.
Thank you, Carol. Before we get into the nitty-gritty on this one, let's refresh ourselves on what the employer mandate is. Now, the ACA requires that an applicable large employer, or an ALE, comply with the employer mandate. Now, an employer is an ALE if it employed at least 50 full-time employees on business days during the preceding calendar year. So in order to avoid paying penalties under the ACA, that ALE has to extend an offer of minimum essential coverage to at least 95% of their full-time employees, as well as any dependent children up to age 26. And the ALE must also ensure that that coverage is affordable, which means that the cost of self-only coverage does not exceed a percentage, which in the case of 2024, it's 8.39%. And that is a percentage of the employee's earnings. And that is determined by applying one of three affordability safe harbors. Now, if an ALE is a control group of related entities with separate EINs, then these requirements and potential penalties apply on an ALE member basis. So each entity in the control group would be responsible to meet these requirements and may also be responsible for paying any penalties if they fail to meet those requirements. In addition, annually, each ALE member of the control group must report coverage offers on IRS Forms 1094 and 1095-C. So what happens when an ALE acquires a non-ALE? The general view is that non-ALEs, that is, an employer that does not employ 50 or more full-time employees, that non-ALE becomes subject to the mandate as of the transaction date. For example, if Patrick's Pizzeria, who has 200 full-time employees, if that acquires all of the ownership of non-ALE Carol's Coffee Company, and they have 40 full-time employees, on August 31st, 2023, and both entities keep separate EINs and corporate structures, the result would be that Carol's Coffee Company becomes an ALE member subject to the employer mandate as of August 31st, 2023. And if Carol's Coffee Company fails to offer coverage to at least 95% of its full-time employees in a subsequent month, then Carol's Coffee Company would be subject to a penalty. If Carol's Coffee Company offers coverage to 95% of the full-time employees, but that coverage is not affordable and of minimum value, the company could also be subject to a penalty. And both Patrick's Pizzeria and Carol's Coffee Company will have Form 1094 and 1095C reporting obligations for 2023. But what happens if you have two non-ALEs and they merge? For example, John's Jelly Beans, which has 25 full-time employees, merges with Carol's Coffee Shop with 30 full-time employees in September of 2023. Well, unfortunately, the guidance isn't clear as to whether combined entities would be subject to the employer mandate in the first year of the merger. There is a special rule that states whether a new employer is an ALE during its first calendar year, and that's based on the employer's reasonable expectations at the time the business comes into existence. But the conservative approach is to treat the newly formed entity as an ALE, offer coverage prospectively to all their full-time employees, and satisfy the reporting requirements. But this is a conservative approach, and again, the guidance isn't clear. So employers who are contemplating such a merger should consult with their outside legal counsel for guidance. Well, when it comes to determining whether or not an employee is a full-time employee under the employer mandate, there are a couple of considerations to take into account. And we'll review some of those here and try to discuss some options in the merger and acquisitions context. Now, we'll be talking a little bit about measurement methods, which in and of itself is a very complex topic. And we do have excellent publications on those topics, but we'll try to touch on them just at a very high level here. But let's start by saying that under the measurement methods, whichever one is used, under the ACA, a full-time employee is an employee that works 30 or more hours a week or 130 hours or more a month. Now, in order to determine whether or not a particular employee meets that criteria, there are two measurement methods that can be employed to determine that. The first is the monthly measurement method, in which an employee's hours of service are evaluated monthly. The second is the look-back measurement method, and this is a method under which an employee's hours of service are evaluated during a measurement period. And during that measurement period, they determine whether or not they worked full-time or part-time during that measurement period in order to lock in that status for an associated stability period. But what happens if one company acquires another and they have different measurement periods? A couple of options here. The first is to treat the acquired employees as if they transferred to a new position with different measurement and stability periods. So if an acquired employee is in a stability period under the seller's plan as of the transaction date, that employee's status remains in effect until the end of the seller's stability period. The buyer's measurement and stability periods would then apply. If an acquired employee has not yet completed an initial measurement period as of the transaction date, say, for instance, they were a new employee of the seller at the time that they were the seller's was purchased by the buyer, the employee's status would be determined using the buyer's measurement and stability periods, but taking into account the hours of service that employee had with the seller, so that the acquired employee didn't lose any hours when it comes to determining whether or not they meet full-time or part-time status. Another option would simply to continue to apply the seller's measurement method to the acquired employees during a transition period following the transaction date. So, which party is responsible for the 1094 and 1095 reporting? Again, this will depend on whether or not the transaction was a stock transaction or an asset transaction. If it's a stock transaction, there are two possible approaches. The first is that the buyer treats itself as a continuation of the seller and files reporting information on the acquired employees for the entire year under the buyer's EIN. the other option is that two separate returns are filed for the acquired employees, one under the seller's EIN for the period prior to the closing date, and a second under the buyer's EIN for the period after the closing date. Now, again, for an asset transaction, remember there is no ownership transfer, so the seller would normally be responsible for the reporting prior to the closing date. However, if the buyer hired any former employees of the seller, the buyer would report on those employees from the hire date, as they would with any other newly hired employees. So let's move on to COBRA obligations in the mergers and acquisitions context. And I will pass this back over to Carol.
Thanks so much, Patrick. It can get complex. AC measurements, AC measurement periods aren't complex enough on their own, certainly in the M&A context. It can get very complicated. So just remind everybody, don't get lost in all the details here. We do have a publication we can share with you, but we're just trying to expose you to the different considerations. Before I move on to COBRA obligations, Roger, do we have any questions that we might want to address at this point?
We actually, we do have one that just has come in that is perfectly timed. It's about the topic Patrick just discussed. The question is essentially if an ALE acquires a non-ALE in, say, June of a year, is that ALE required to report coverage information that we just talked about for that non-ALE for the months preceding January through May?
If it was an asset or a stock transaction?
That's an excellent question. The question does not specify. Let's walk through each of them. If we let's suppose it's a stock first or an asset first. We do that one first, and then we'll address the stock issue.
Well, any employees acquired by the non-ALE or would be reported as of the date of the stock of the transaction date, right? So
Correct.
Depending on whether again, we don't know if the seller is continuing to exist, so they still have something to report. But in those cases, it's usually they report the seller reports before the transaction date and the buyer reports after.
And I think the concern that the question may have also is, and it is an interesting question, is that essentially, let's suppose this purchase was made and this company had about just 20 employees. It's a non-ALE, and so maybe the sub question too is that's being asked is what about those months? And we may not have that granular answer right now with us, but the months before, if they're responsible for doing it, how do you report those months before? Maybe sort of the subtext question there, and we may not know that offhand.
Yeah, I don't have a ready answer for that one.
But they would be responsible in that particular case, though. Yeah.
Yes.
Okay.
In absence of other considerations.
The stock purchase, would that be different?
That is a potential solution to the stock purchase. And of course, there's the other one which she discussed briefly is that the buyer would just report for the whole year.
Okay. Thank you, Patrick. Carol, back to COBRA.
Okay, thank you. Okay, so moving along to COBRA, and a lot of questions arise with COBRA. The good news here, though, I just want to mention is that we actually do have default rules. With a lot of areas of the law in the M&A context, there aren't specific laws, and you have to do your best to navigate how they'd apply with to a merger or acquisition. We do, though, have COBRA laws specific to this context. When do they come into play? I just want to explain this up front. They come into the play if the parties didn't negotiate anything in their transaction agreement. So we still always need to know, what's in the transaction agreement. And they could also come into play if the parties did negotiate something in the transaction agreement, but one of the parties failed to fulfill their obligations, then the default rules would kick in again. So let's just take a look at some of the questions that arise in relation to COBRA. Will the transaction itself create COBRA qualifying events for the seller's employees and their dependents? Which party is responsible for providing coverage to the M&A COBRA qualified beneficiaries? What happens if the responsible party, for example, the seller in a spin-off transaction, does not maintain that plan that previously covered the employees, or doesn't maintain any plan? If two small employers, let's say each with less than 20 employees, merge together, when does the COBRA obligation begin? And many more, depending on the particulars of the transaction. Let's see if we can answer some of those questions. Does a COBRA qualifying event result from a stock purchase? Well, with a stock purchase, as Patrick had explained earlier, if employees continue employment with the acquired company after the purchase, there's no qualifying event because there's no termination of employment. So an example here, the buyer acquires 100% of the stock of the seller and employs all of the seller's employees. The employees were previously covered under the seller's group health plan, but the plan was terminated on the closing date. The result here is that the acquired employees and dependents lose coverage, but they're not entitled to COBRA because there's no qualifying event. And I think that surprises some people because often we think there's a loss of coverage and we think, oh, there's an entitlement to COBRA, but we have to remember that there's really 7 specific events that can cause COBRA obligations to attach, and there can be losses of coverage without a COBRA obligation. Now, the buyer is generally, so the acquired employees and dependents lose coverage, but they're not entitled to COBRA. There's no qualifying event. The buyer is generally viewed as the successor employer to the seller's employees. Very likely the buyer will offer coverage to the acquired employees, but even if the buyer doesn't, there typically is no COBRA qualifying event. Next slide. And does a COBRA qualifying event result from an asset purchase? With an asset purchase, the employees who lose group health plan coverage due to an asset purchase generally have a qualifying event. Employees have a termination of employment with the seller, even if hired by the buyer. Example, the seller has 3 divisions, TUV, and provides group health plan coverage to employees of each division. The seller sells Division V to the buyer on August 31st of 2023. The V employees are terminated from employment with the seller, and they lose eligibility for the seller's group health coverage on this date. The buyer hires all of the V employees and offers group health coverage. The result here is that all of the Division V employees and their spouses and dependents are COBRA qualified beneficiaries. Again, because it's a termination of employment, so it's a COBRA qualifying event, even if they're hired by the buyer. Now, there is an exception, and this is where their buyer is considered a successor employer. And with the default rules, just generally speaking, the defaulting, the party with the obligation under the COBRA default rules to provide COBRA is the seller. But there are situations in which it's going to transfer back to the buyer. And the situation is when the seller, as defined on a control group basis, doesn't offer any group health plans any longer after the transaction. So when that happens, the seller's not offering any group health plan in connection with the transaction, and the buyer with an asset purchase is continuing the business operations associated with the assets purchase without interruption or substantial change. So in some cases, and not all with an asset purchase, if they're really continuing those operations uninterrupted, and they've taken on a large portion of the obligations of the seller, then that COBRA obligation may revert back to the buyer in an asset purchase. And of course, this, whether the buyer is continuing the business operations without interruption or substantial change, it is a facts and circumstances determination. Which party is responsible for providing coverage to the M&A COBRA qualified beneficiaries? And by M&A qualified beneficiaries, we're referring to those whose COBRA qualifying event occurred prior to the transaction. If there's a division that's been sold off, there may be people who are already on COBRA who had terminated from employment from that division before the transaction occurred, and also those who become COBRA qualified beneficiaries in connection with the transaction. So as I mentioned earlier, the general default rule is that if the seller maintains any group health plan after the transaction, the seller must provide COBRA coverage to those M&A qualified beneficiaries. So if the seller terminates the plan of a sold off asset, a division, the seller must provide coverage under another of its plans. Again, an example here, the seller sponsors a group health plan for each of its 3 divisions, TUV. The seller sells Division T to the buyer and terminates the Division T group health plan. Now the seller must provide COBRA to the former T employees under either the Division U or V group health plans. And that's sometimes surprising to the seller. They don't realize this because now, they have this obligation to provide COBRA, but it has to be done under a plan where the COBRA beneficiaries were never active employees. So that's something that the seller would really need to work out in advance with their carriers and TPAs to provide coverage to those COBRA qualified beneficiaries. The exception here is if the seller ceases to maintain any group health plan, then the buyer's group health plan must provide the COBRA coverage if the buyer maintains a group health plan. And as I mentioned, in the case of an asset purchase, the buyer is considered a successor employer. All right, so here's a chart just to map out those rules, defining the transaction. Again, the buyer in the stock purchase is purchasing all the stock or ownership in the seller's business or a unit thereof. And the employees of the purchase business would continue to be employed by the same legal entity, but the ownership of that entity has transferred from seller to buyer. With the asset purchase, the buyer is purchasing some or all of the seller's assets and may be assuming certain liabilities. Employees of the purchase entity would normally be considered terminated employees of the seller, but often these employees would be rehired by the buyer and become new employees of the buyer. So our default COBRA rule, the seller maintains any group health plan after the transaction. The seller is responsible for offering and maintaining COBRA coverage for any of those COBRA beneficiaries. The seller doesn't maintain any group health plan after the transaction. Then with a stock purchase, any terminated employees and any present COBRA beneficiaries under the seller's plan would be eligible to continue coverage to the buyer's plan. And if it's an asset purchase, those terminated not rehired employees and any present COBRA beneficiaries under the seller's plan would be eligible to continue coverage through the buyer's plan if the buyer is a successor employer. And then what happens if there's a merger of small employers? If 2 small employers, each with less than 20 employees, merge together, when does the COBRA obligation begin? The small employer exemption we know from COBRA applies to employers, again, is defined on a control group basis, with less than 20 employees on at least 50% of their typical business days in the prior year. So with a stock transaction, for example, a merger, the employees of both entities in the prior year must be counted for purposes of the exception. So Company A merges into Company M on October 1st, 2023. Each company had 12 employees in 2022. The result here is that surviving Company M is subject to COBRA as of October 1st, 2023, because the combined employee total in 2022 was 24, 20 or greater. With an asset purchase, the parties do not become related entities as a result of the transaction, so their employees in the prior year do not need to be counted together. Example, the buyer purchased Division D from the seller on February 1st of 2023 and hires all 10 Division D employees. In 2022, the buyer had 15 employees, the seller had 30, including 10 in Division D. So we're over the 25 threshold with the 15 and 10 in Division D. But the result here is that the buyer's plan would continue to be exempt from COBRA in 2023, but COBRA would apply as of January 1st of 2024 because the buyer employed 20 or more employees on at least 50% of its typical business days in 2023. And with that, I will turn the presentation back to you, Patrick, to discuss cafeteria plans and FSA options.
Thank you, Carol. Well, of course, as many of you know, in a cafeteria plan, participants are able to elect benefits such as a health FSA, and then pay their share of premiums for those benefits on a pre-tax basis. So these are also affected in many ways by mergers and acquisitions. And so we're going to highlight or touch on some high-level considerations with cafeteria plans in general, and then we'll focus a little bit on FSAs in particular, since in our experience, many questions that we receive concern how healthcare FSAs, general healthcare FSAs, are affected by mergers and acquisitions. So the first question, or the general question we should be asking, is how are the cafeteria plans addressed in an M&A context? Again, this is going to depend on whether or not it's going to be a stock purchase or an asset purchase. With a stock purchase, the buyer typically assumes sponsorship of the seller's plans. Plan participation and elections would continue for those acquired employees who would be bound by the elections they made back when they were working for the seller. Now, the buyer may prefer to terminate the seller's plan as of the transaction date. That's certainly possible, but in such event, it's unclear whether new mid-year benefit elections would be permitted under the buyer's cafeteria plan. So some consideration should be paid as to whether or not that would be possible under that particular transaction. In addition, issues may arise with a mid-year plan termination if participants are not provided with sufficient notice to use their existing balances, particularly in that FSA context where the participant would be contributing money into their account, but if they don't use that money, they lose it. And if they've got a lot of big balances and they're looking at a point where they can no longer access that money, it's something that they should be aware of. Now, in an asset purchase, for employees of the acquired business, the employment, of course, was terminated by the seller, and those employees become new employees of the buyer. Their participation in elections in any cafeteria plan and health FSA benefits maintained by the seller would typically terminate then on the transaction date because they're no longer employed by the seller. They're no longer able to participate in the seller's cafeteria plan or that health FSA. Employers hired by the buyer may be offered participation in the buyer's cafeteria plan and also the health FSA if there is one. And those would be given so those employees would be given the opportunity to make new elections under that new plan. But these employees may have large forfeitures under the seller's plan. And that's where a lot of our questions about health FSAs come in. So let's dig into that a little bit. Now, the IRS does address health FSA options for asset purchases, and they have informally stated that these options could also apply to a stock purchase. So let's go over those options here. The guidance provides two possible transition approaches, which would apply if, one, the seller continues its business operations in health FSA after the asset purchase, and two, the buyer either has or will create a cafeteria plan that offers health FSA coverage. If those two conditions exist, there are two options. The first option is that the parties could agree to have the transferred employees continue to participate in the seller's FSA plan through the end of the plan year. Those employee salary reductions elections would continue, but as if it was made under the buyer's plan. In the second option, the buyer could agree to cover the transferred employees under its health FSA for the remainder of the plan year. Employee account balances, whether they're underspent or overspent, under the seller's health FSA would be rolled over into the buyer's health FSA. Claims for reimbursement after the asset purchase would be submitted to the buyer's health FSA, and those would include claims incurred before the transaction that were not yet reimbursed. And then, of course, employee elections would continue for the balance of the plan year under the buyer's plan. But what happens when we're talking about dependent care FSA considerations? Now, guidance does not specifically extend those options that we just discussed to dependent care FSAs. And in this context in particular, counsel should be consulted. But in the event of an asset purchase, the seller could consider adopting a spend down feature. Now, spend down would allow the terminated employees to be reimbursed from their dependent care FSA balances for eligible expenses incurred during the remainder of the plan year. So expenses could be reimbursed while the employees were working for the buyer. Otherwise, employees may be limited to reimbursement for expenses incurred prior to their termination dates. But can various members of a control group participate in the same cafeteria or group health plan? Businesses that are part of a control group may provide a single cafeteria or group health plan for all of the employees. In the alternative, one or more of the businesses may have separate plans for their own employees. However, plans would need to satisfy the applicable non-discrimination rules for cafeteria plans and self-insured plans, which is a good segue into our next topic, non-discrimination rules, which I'll now pass over to Carol.
Oh, thanks so much, Patrick. And we can move ahead to the next slide. Okay. One question we often receive, both in the M&A context and outside of it, is can benefit offerings be varied for different control group members? Plan eligibility, benefits, and contributions can be varied, provided the variance is by a bona fide classification of employees. Examples would be variances based upon geographic location, the entity, business line, or occupation. And these are not exclusive. I'm just giving a few examples here. There are many others where there's a distinction that's made. There's a legitimate business purpose, and it's not just done for the purpose of the benefits, and you're not handpicking selected employees. So generally with these classifications, variances are permitted, but the variances must comply with the applicable non-discrimination rules. The Section 125 non-discrimination rules apply to pre-tax benefits under a cafeteria plan and prohibit variances in eligibility, benefits, and contributions that disproportionately favor key or highly compensated employees. The Section 105 non-discrimination rules apply to self-insured plans and are also designed to prevent non-discrimination in favor of those highly compensated employees, although the definition of a highly compensated employee varies from that under the Section 125 rules. But what's important to know here is that the Section 125 and Section 105 tests take the employer's entire control group into account. So how does the control group status factor into the non-discrimination test? Because I think it's a little confusing sometimes. You know, we test by plan and we say we take the whole entire control group into account. So let's just see how that could happen. First, the determination of HEs is based on the entire control group. Under the Section 125 rules, an HE includes an officer, a greater than 5% owner, or any individual who earned more than $150,000 in 2023, or $155,000 if a new employee in 2024. Under the Section 105 rules, an HE is one of the top 5 paid officers, a greater than 10% shareholder, and anyone in the top 25% of all employees. So if we look here at the graphs here, if we look at that top 25% of all employees, and it's on a control group basis, just think how that can be affected, by a merger or acquisition, right? That group is going to change who we're defining as a highly compensated employee. So that's one example. Okay, going on to the next slide, please. How do mergers and acquisitions impact the non-discrimination testing? Well, a merger, acquisition, or other transaction typically results in changes to the buyer and seller's control groups. And we know that happens in a stock transaction. That's what a stock transaction is all about. Since aspects of non-discrimination testing consider the employee's entire control group, a business reorganization can impact the testing results For an example, an acquisition or spinoff can change the HC population and benefit offerings of the control group. If the buyer will be taking over the plans of the seller in a stock purchase, those plans will need to be included in the testing. The employer should consult with the party responsible for the non-discrimination testing in advance of the transaction if possible. And again, I know, like Patrick said, benefits don't drive the transaction, and often it's an afterthought, but if you can look into it prior to the transaction, that's generally advisable. In any event, mid-year testing is recommended so the employer can make necessary adjustments before year ends, and this helps to prevent negative tax consequences to the HCEs. Yeah, I think particularly in the M&A context, it's a good time to review the status of the control group and the non-discrimination testing. An employer may be going somewhat on autopilot if their demographics, their employee group is rather static, and the merger acquisition can have a significant impact on that in some cases. And with that, Patrick, I'll turn the presentation back to you just for some key takeaways.
Thank you, Carol. As we've demonstrated over the last over the course of the webinar, merger and acquisitions, of course, are highly complex transactions, and the benefits considerations for a merger in this context are no different. But hopefully we have stressed that employers should take benefits administration issues into account early and often, especially, starting with due diligence and on through to the end of the transaction. Outside legal counsel would be very important in this area, and they should be involved again as early as possible to help identify those issues and help solve those problems if any problems arise. It's also really important to know the type of the transaction, whether or not it's an asset or a stock transaction. Ownership structure and control group status is also incredibly important when trying to evaluate issues relating to benefits compliance. Default rules do exist for COBRA and for health FSAs, and I tried to highlight those for you today. But just keep in mind that parties can negotiate other terms during the course of the transaction, and if they do so, those should be included in the purchase agreement. It's also really important to communicate any benefit plan changes in advance with the employees that will be affected by the merger or acquisition. Now, again, it's a complex topic, and we've tried to give you a high-level overview over the course of the webinar, which in itself was probably pretty dense and complex. But these slides will be available after we're done here, and we also have an excellent publication that covers a lot of these issues as well in a little more depth. So please be sure to ask your NFV consultant or broker for a copy of that publication, and hopefully that will help you identify some of those issues as well. So thanks for joining us, and let us know if you have any questions.
All right. Well, thank you, Patrick and Carol, for sharing your valuable time and expertise with us today. To reiterate, today's presentation has been recorded. We will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you, everyone, for joining us, and have a great day.